Welcome back to the deep dive, where we tear into the documents and get you the insights you need.
Today, we are really getting into a fascinating one. It's Monday.com's Q3 fiscal year 2025 earnings call.
And it is a perfect case study in, well, I guess you'd call it cognitive dissonance in the market.
That's a great way to put it. The call was on November 10th, and the company basically reported a fantastic quarter. I mean, record profits, solid revenue beat.
And the stock just got annihilated, a massive double-digit sell-off.
Exactly. So that's the whole tension. Management is on the call talking about strong results and disciplined execution, and they have the numbers to back it up.
But the market saw something completely different, or maybe chose to focus on something different.
And that's our mission today. We're going to unpack those Q3 numbers, look at the guidance, and really scrutinize the narrative to figure out why investors completely ignored record profitability and ran for the hills because of a cautious Q4 outlook.
It's the classic short-term fear versus long-term fundamentals story.
Absolutely.
Okay, so let's start with the headline numbers from Q3, because on paper, they look great.
They do. Revenue was $316.9 million.
Which beat the consensus of, what, around 312?
Yeah, $312.3 million. So a nice beat. That's 26% growth year over year. Solid.
And the profitability, that seemed to be the real standout.
Oh, it was a blowout, complete blowout, non-GAAP diluted EPS. It came in at $1.16.
$1.16. The street was expecting something like 88 cents.
Exactly. I mean, it just dwarfed expectations.
Okay, so let's just pause there for a second. Non-GAAP. For anyone listening who isn't buried in these filings all day, why is that metric so important?
It's crucial because it shows you the core operational profitability of the business. It strips out things like stock-based compensation non-cash charges.
So it's a cleaner look at how the actual business is performing day to day.
Right. And when you see a beat that big on non-GAAP EPS, it signals incredible financial discipline. They are managing costs and scaling efficiently.
So strong revenue beat, massive profitability beat. What on earth happened to the stock?
Total carnage. The market sentiment just flipped to cautious instantly.
How bad was it?
Shares were down, I think, 17 to 19% in pre-market trading. They ended the day down about 12%.
Oh, and the volume?
The volume spike was huge, about 5 times normal. It tells you this was a real liquidity-driven panic.
Yeah.
Everyone was trying to get out at once.
All because the Q4 revenue guide was a little light.
That was it. The entire sell-off was pinned on the Q4 guide of $328 to $330 million, which was just a hair below what analysts had been modeling.
Incredible. Okay, let's dig into the execution story that management was trying to tell, because it seems like the market just wasn't listening. Profitability first.
Yeah, they are clearly shifting from just growth at all costs to profitable growth.
Yeah.
And doing it well. They hit a record for non-GAAP operating income.
What was the number?
$47.5 million.
Yeah.
That's a 15% margin, up from 13% the year before.
That's a strong margin. But what about actual cash?
Even better. Adjusted free cash flow FCF was a huge $92.3 million.
Wow. And what does that translate to in margin terms?
That's an adjusted SCF margin of 29%.
29%. So for every dollar in sales, almost 30 cents is turning into actual usable cash.
Exactly. It just proves they're scaling incredibly efficiently, even while they're still investing heavily in the business. You can't argue with that kind of cash generation.
Okay, so that's efficiency. Now, what about growth? Management kept stressing their move upmarket to bigger enterprise customers.
And this is probably the strongest part of the long-term story. The numbers here are actually accelerating.
Let's start with RPO, remaining performance obligation.
Right. So this is the value of contracts that are signed but haven't been recognized as revenue yet. Think of it as their future revenue pipeline.
And that grew.
It grew 36% year over year to $747 million.
So their backlog of future business is growing faster than their current revenue. That's a very bullish sign.
It's a huge leading indicator. And then you look at who is signing those contracts. Their target cohort, customers spending over $100,000 a year. That group grew 48%.
Almost 50% growth in their biggest customers.
They're at over 1,600 of those customers now.
And are those customers sticking around? Are they spending more?
They are. The overall net dollar retention, or NDRR, was a solid 111%. But for that key upmarket group, the 100K plus customers, it accelerated to 117%.
So they land a big one, and then that customer spends 17% more the following year.
Exactly. The land and expand is working perfectly. They even mentioned on the call they closed two huge deals this quarter, a big logistics company and a major tech firm, both over $1 million a year.
Okay, so the core strategy seems to be firing on all cylinders. What about the product story? They're trying to become a multi-product company, not just a one-trick pony.
And they just hit a huge milestone there. Their new products, that's the CRM, dev, service, and campaigns tools, they now make up over 10% of their total annual recurring revenue.
And that's a big deal
Because they hit their internal 2025 goal for that metric way ahead of schedule. It shows the new products are getting real traction.
the CRM space especially is so crowded.
It is, but their CRM product passed $100 million in ARR in less than 2 years. And they also pointed out that their service product is seeing great adoption. The average customer using service is twice the size of customers on their other products.
So that's another engine to drive that lucrative 100K plus customer cohort.
Precisely.
And what about AI? They talked a lot about Monday Vibe.
The adoption numbers there were just kind of stunning. Vibe is their low-code platform. In just about 3 months, users have built over 60,000 apps on it.
60,000. That's insane engagement.
It's a huge indicator of platform stickiness. They also rolled out Monday campaigns and something called Agent Factory, which is for building complex automated workflows.
So are they actually making money from AI yet?
They're starting to.
Yeah.
They introduced new pricing for Vibe, and an AI credit system is coming in Q4. But for now, management was pretty clear.
What'd they say?
They see AI primarily as a tool for retention and stickiness first, make the platform indispensable. The direct monetization will really start accelerating more in fiscal 26 and 27.
Okay, so this brings us right back to the central problem, an amazing story of execution and future growth potential. All of it ignored because of the Q4 guidance.
That's it. And you have to remember, the market was already jumpy. Their guidance last quarter was also a bit cautious, and the stock sold off then too.
So in this Q4 guide, which implied, 22 to 23% growth, came in below expectations?
The panic just set in all over again. The deceleration fears came roaring back.
Okay, I have to stop you though. Management calls this a timing effect. The market is clearly pricing it as a permanent slowdown. Why should anyone believe this isn't just a real deceleration because of the macro environment?
That is the absolute core of the debate. And they spent a lot of time on the call explaining their reasoning. It all comes down to a deliberate strategic shift in their go-to-market strategy.
It's their GTM. What's changing?
They're rebalancing. They're moving investment away from the high-velocity, bottom-up marketing that catches tons of small customers quickly.
So less fishing with a wide net.
Exactly. And more. Fishing with a spear. They're shifting to mid-funnel channels and direct sales teams that specifically target those larger, higher quality $50,000, $100,000 plus accounts.
Right, but that kind of sale takes longer.
That's the whole point. It has a short-term timing effect, as they put it. These big direct sales cycles for products like their CRM and service tools, they just take months longer to close.
So $1 million deal doesn't close in a week like a $10,000 one might.
Right. And that lag, that delay, is what's pushing some of the recognized revenue out of Q4. The market sees slower growth now.
But management is saying that's a side effect of hunting bigger, better deals that will show up later.
That's their argument. And they confirmed they are still investing heavily in growth. Headcount is up 30% this year, mostly in sales and R&D. So it's not about cutting costs.
And they stuck by their long-term targets, right?
They did. They explicitly reaffirmed their fiscal 2027 revenue target of $1.8 billion. They even said they're comfortable with the current consensus numbers for fiscal 26.
And their reasoning for that confidence was what? The RPO growth?
The accelerating RPO, yes. The expansion in those upmarket customers. And the huge, huge cross-sell potential.
How big is that?
They said only 6% of their customers currently use more than one Monday product.
6%. So 94% of their entire customer base is untapped potential for expansion.
It's massive white space. So you can see the story management is telling. They're basically saying, look, we are building a much better, more durable, more profitable long-term business. You just have to be patient for a quarter or two for the revenue to catch up with the contracts we're signing.
Okay. This is the deep dive. And while we never, ever offer financial advice, we do like to break down an outrageous but plausible trade idea based on the kind of extreme day divergence we just walked through.
And this is a textbook divergence. The market absolutely hammered the stock for what management claims is a short-term timing issue.
while completely ignoring the 36% RPO growth and the record 29% free cash flow margins.
Right. So you have this huge dislocation between the short-term fear and what looks like very strong long-term fundamentals.
So how could you structure a trade to play that exact conflict?
Well, you could get really aggressive with the capital structure. You could essentially sell the fear to fund the conviction.
What does that mean in practice?
It means you could, for example, sell short-dated, high-premium strangles, say, 60 days out. You're selling options to capture the high volatility premium that this earnings panic created.
So you're collecting cash by betting that the stock won't be as volatile in the next 2 months as the market thinks. Where does that cash go?
Use that cash, that premium you collected, to buy long-dated, deep-in-the-money call options, EAPS, expiring in 2027.
Ah, I see. So you are literally using the money from the market's short-term panic to place a direct long-term bet on management's ability to hit that $1.8 billion revenue goal in fiscal 27.
That's it, exactly. You monetize the present fear to fund a position on the future growth story, which that 36% RPO growth suggests is still very much on track.
That's a fascinating structure. So to bring this all home for you, the listener, this entire Q3 call boils down to one central conflict. You have stellar execution on profits and a successful strategic shift upmarket,
Crashing directly into near-term revenue fears that are being driven by a necessary but for the market, painful go-to-market rebalancing.
So what's the final question for our listeners to think about?
The primary question for you to consider is this. Is the timing effect that management keeps talking about just a mask for a genuine healthy shift to higher quality enterprise revenue that will show up later? Or is it the first sign of a real enduring slowdown that the market is right to be worried about?
Synthesize that knowledge, apply it to your world, and we'll see you for the next deep dive.